Ever dream of owning a home and struggled with getting a hefty down payment? You're not alone. On this episode, we're going to go over 100% down payment assistance programs and discuss pros and cons. Could this be the key to unlocking your dream home, or could it be a financial trap? Hello, and welcome back to the Happy House Hacking Podcast, the podcast designed to help young people in California navigate the path to happy home ownership. I am your host, Owen Schwaegerle. I'm a realtor, investor, and happy house hacker. And on today's episode, we're going to be talking about 100% financing options, how to get into home ownership using these programs, and whether or not it's really worth it. Okay, let's start with the pros. So there are loan programs right now you can use to get in with 100% financing. In California, we have the CalHFA. The state will actually give you the down payment to help you get into the home. So 3.5% down is the minimum FHA loan requirement. The state will give you that money as a grant, and it's recorded in a second position on the property. So believe it or not, you can actually get into a home with 100% financed, no money down. Sounds great, right? Is it too good to be true? Well, it's not. It's possible. So here's pro number one, getting started on your home ownership journey. You'd be able to buy a house quicker without having to put as much down, right? There is the option you can save and get 20% down. It's just a lot of time, a lot of energy, a lot of effort to save that much to get started. So when you're looking at the average price of a home in California, and you could get started with the down payment assistance programs that we have available, boom, you're in. You're into home ownership. All right, that's pro number one. Pro number two, preservation of savings. You don't have to expend all your savings on your purchase. Why is this great? This is great because homeownership is expensive. As soon as you buy a house, there could be repairs that need to be happening. Maybe the roof needs to be fixed if there's a leak. Maybe a water heater goes out. Maybe you need to update the flooring. Maybe you need to update the bathrooms. And so when you're coming into homeownership, if you can do less down, that means you have more money in your pocket to go ahead and fix up the property. So you can keep it as an emergency fund, you can keep it to fix property up and cover those unexpected costs that come up with home ownership. All right. Number three, benefit property appreciation. In markets where values are continuing to increase, like California, where we have a low supply of homes, we have steady demand, a lot of people want to buy houses here. That hasn't stopped. Prices are expected to increase. In fact, if you look back at the past 100 years of real estate values in the United States of America, homes have appreciated on average about 5% a year. So you know that this house that you're trying to buy today, a year from now, 2 years, 3 years from now, is going to be more expensive when you do get in the game. And so the sooner you can get in the game, typically the better. So let's just run some numbers on this, okay? The median price of a house in California is about $800,000, okay? That's expensive. So if you had to get 20% down on an $800,000 house, we're talking $160,000 in your down payment. That's pretty expensive. Now, if you were able to save money, let's say you're saving $2,000 a month, which is a pretty healthy savings rate. You could, be renting a place in theory and then saving that much money. It would take you 80 months to get to $160,000. That's 6.5 years. And so during that time, if home prices were appreciating at 5% annually, plus that's compounding, it's 5% on top of 5%, on top of 5%. That same $800,000 house, 6.5 years from now, would be worth approximately $1,098,878. So even if you were saving a lot of money for a long time, you can't outsave the market. I mean, you'd have to save an extra $60,000 for that down payment on that house. So you're actually underperforming the market. And so realistically, if you can get in sooner with less down, it's going to benefit you because it's very hard to outsave the market. So let's say in that same scenario, maybe you put down 5% instead of a full 20%, and you had some skin in the game. You're starting to get that appreciation. You would essentially have built $300,000 in equity over that period of 6.5 years. So even if you had to pay PMI, which is the mortgage insurance, because you put less down, the mortgage insurance would far exceed what your appreciation on that house would be. And thinking about property appreciation and prices, I remember when I first got started in real estate, everyone was saying, "Oh, I'm waiting till the market crashes. I'm going to buy property once prices come down." And that was back in 2017. And I remember reading headlines. There's a new bubble in the real estate market. Prices are inflated. Things are overvalued. And there was all kinds of bad news, bad media about real estate pricing from 2015, 16, 17, 18, 19, 20. I remember reading all these headlines. And if you had been listening to the headlines and sitting on the sideline, the average price point on a house in America from 2015 to 2020 went from around 300,000 up to 450,000. And so if you were listening to the news, listening to the media, this is nationwide averages, by the way, you missed out in 5 years on $150,000 in equity potential just by owning that asset. So price appreciation is a really big thing and a benefit as to why you may want to get in with less down, including some of these 100% financing options that are available. Okay, number 4, inflation protection. So inflation, it's gone rampant the last few years, and with it, rent has inflated. Think about it. I looked at some data, and you go back to 2020, the average rent for a house was about $1,100 in California. Today, it's about $2,800. So, 24 years later, your rent payment has gone up quite significantly. $2,800 per month for the average home as a rental in California. So, if you have a fixed rate mortgage, your payment is the same. You can budget for it. You know what your monthly payment is going to be. And if you don't have a fixed rate mortgage, if you're subject to the market, if you're subject to inflation and rents, you're just a lot less secure. You have a lot less stability. And I think about some of the stories of people. We've helped people buy homes, and they're intending to move into that house, and there may be a tenant in place currently. And so in California, there is the Tenant Protection Act, and you have to have just cause to evict someone, which means ask them to leave the property. Well, if you just bought a property and you're intending to move into it as your primary residence, you have just cause to ask the tenant to leave. You just bought the house, you need to live somewhere. And so you can ask that person to leave. So in this one situation, there was a tenant who had lived in the same house for 8 years, and they were doing great. They were only paying $1,200 a month in rent. The old landlord didn't raise their rents. And so it seems, if you look at the market today, they're getting a great deal for a 1-bed, 1-bathroom in San Luis Obispo, $1,200, really good deal. However, eventually that is going to catch up to you. So 8 years later, yeah, they thought they were beating the market and having a great rent by staying in the same spot. But now the owner asked them to move out because they have to move in. And when you're looking for a 1-bed, 1-bath right now in the area, you're going to be paying somewhere around $2,150 to $2,250, maybe a little bit more, $2,500. So your rent almost doubled. And you can't control it. You can't control the market. You don't know what's going to happen. Homes buy and sell all the time. People come in, change their plans. So that didn't work out in their best interest for that tenant. Unfortunately, the rent they're going to pay is double what they were currently paying. And so it really is tough. And so that's why home ownership is so important. You get in sooner, you have stability. Another thing we have in California is what's called Prop 13. And so your property tax basis is based upon the purchase price, and it only goes up by 2% a year. So they've fixed it. It's indexed against inflation of 2%. So your property taxes will stay pretty low the longer you stay in a house. It's a hedge against inflation. Whereas if you bought that same house that used to be 800 and you buy it today for 1.1, 6.5 years after, you tried to save up to buy it, essentially your property tax bill is going to be hundreds of dollars more per month just because you tried to wait. $300,000 differential in price equals a $3,000 per month difference in payment on your property taxes alone, not including the higher interest and the higher mortgage you'll pay because you have a higher purchase price overall. So that is another reason why you want to get in is inflation. The sooner you get in, you lock in your rate, you lock in your payment, you lock in your property taxes, and then the market can continue to go up, things can go crazy, but you're locked in, you've got that hedge. And then number 5, buy sooner rather than later because of the tax benefits. And think about it, we're paying so much in taxes all the time because you've got your, employer, employee, you've got property taxes. If you own property, that is deductible, by the way. You've got sales taxes, you've got income taxes, you've got so many different taxes you pay. If you had a way to reduce your tax burden, why not take it? And this is one of the best and easiest ways for the average American to reduce their tax burden. The interest on your home mortgage is tax deductible. So you get to write that off. You get to reduce what you pay in taxes because of it. And so while your monthly payment appears to be higher when you're renting or when you're buying versus renting, you have to factor in, okay, a portion of that payment goes to principal. So that's like money back in your pocket. You're building equity that way. And then the tax savings. So at the end of the year, you'll pay less in taxes because you own that property. And that could be a couple $100 per month, maybe $300, $400 a month. So if you factor in that plus your principal pay down, you're really saving more money and putting more money back in your pocket through ownership. Okay, so those are the pros, kind of the benefits of why buying a house sooner rather than later makes sense. However, there are risks. So be warned, buying a house with 100% financing can have some downsides. So let's cover those. So number 1, higher interest rates. If you are borrowing a lot more money, the lender sees that as a higher risk. So they're going to charge a higher interest rate to mitigate the risk associated with lending more money. And over the life of the loan, that can result in tens of thousands, maybe even hundreds of thousands more spent in interest just to get into the property. So you have to factor that into your analysis to see if it's worth it. Number 2, no equity cushion. This is really risky, okay? You come into a property with nothing down. All it takes is the market to swing a little bit and you would be underwater, meaning you owe more on a house before you owe more on the house than what it's actually worth. So that can be a real big problem. And that's kind of what happened in the recession. Home values dipped and then their mortgage was more than what the property was worth. So when they had to sell it, it turned into a short sale situation, which is where the bank sells it for less than what is owed. It's called a short because they are getting shorted the money that they are owed. So no equity cushion. This could be a risk if you're trying to refinance. If you want to refi, well, if there's no skin in the game, the banks aren't really going to be excited about giving you a new loan. Okay, private mortgage insurance. So this is called PMI or MIP. And what that is it's basically an extra fee you pay the bank in order to give you the loan. It's like insurance for them, not for you. It insures them in case you default. So you're paying them more in case you default. So it's like mitigating their risk even more. So you pay a higher interest rate, you're paying higher fees typically on getting into a loan with less down. And then you have this PMI, which can make that mortgage payment less affordable and reduce the overall financial benefit of owning that home. So there is risk. You have to factor that in. And let me just run some numbers by you real quick, okay? Let's say you wanted to purchase that house, the $800,000 house, and you wanted to do 20% down versus doing the low down or no down options with the Cal HAFA and the down payment assistance programs. You might have to pay mortgage insurance. And let's just say that mortgage insurance is somewhere around $200 to $450 a month. Okay. It's an extra fee that you have to pay. Obviously, that isn't great. Now, if that $800,000 house is going up at 5% per year, that's $40,000 in appreciation simply in year one. And so what that means is you'd have to, or the value of the property is going up essentially $3,333 per month. So even though you're paying, let's say, an extra $200 to $400 per month to get into it, your appreciation is going up by $3,300 per month. So your value, the asset, is going up in value. So even though you're spending maybe $400 a month on a mortgage insurance premium, it's like an investment because you're essentially getting that $3,300 in growth in the asset. So it can be worth it. And in order to really make it work, if you were trying to save up, to outsave the market, you'd have to save your down payment money, which if you're trying to save 20% on 800, that's 160. So that's $2,000 per month over 6.5 years. Plus, on top of that, factoring in inflation, you'd have to save an extra $3,300 a month. So really, can you outsave the market? It's really challenging. You could potentially save and invest, but on average, across America, if you own a house for 3 years and you live in it, you're going to be better off owning than renting, taking your savings from renting and investing it at a 10% rate of return. So ultimately, it is still a great decision to buy when you can financially afford it. Okay, number 4. This is another con. It's limited financial flexibility. So once you are locked in to purchasing a house, you have to pay the mortgage. And if you don't, you lose the property. So there is limited options, especially with such a low down payment. It's going to be tricky to sell it or refinance it anytime soon. So you have to make sure you're comfortable with that mortgage payment and that you are able to withstand that mortgage payment until you hit an equity position in the property where you could refinance and drop out of PMI. That's what we did. When we bought our first place, we did 5% down. We had to pay mortgage insurance on the property. It was like $200, maybe $25 a month, something like that. And until we were able to hold it for a few years, rates came down, prices went up, we were able to refinance and drop out of PMI, get a lower interest rate. And so we were saving $225 a month off of PMI. And that's money that we could then put back towards the payment and keep making your payments to build more principal. And so that's more money back in your pocket through principal pay down. Okay. And risk number 5 of doing 100% down financing is missed opportunity for better terms. So if you can put down a larger down payment, you're going to get better terms. That means better interest rate, less origination fees, you're less risk. So they're going to give you better terms ultimately. So it costs more to do less down, However, if you factor in what your market appreciation could be and what the tax benefits could be and the cost benefit analysis of ownership versus renting, you may come out ahead using one of the 100% down financing options out there. So this can be a great tool for achieving home ownership, especially in areas where maybe you have a really great income, but you haven't been able to save up that down payment. And so you could handle those monthly payments. However, you just need help getting into the market. And so those risks you have to keep in mind. You could have a negative equity position. You will have limited financial flexibility, and you'll have higher costs for doing a loan program like this. So for some people, 100% down financing may be the key to unlocking home ownership. And we've done that with many of our clients. They've taken advantage of these loan programs. They're out there to help people. And so if you want to learn more about 100% down financing and see if it's the right fit for you, contact our team. We want to meet you. We want to sit down with you and make a game plan to help you buy and get into home ownership, whether that's here in California or anywhere in the nation. We know people nationwide that can help you achieve your dream of happy home ownership. So thank you so much, everyone, for tuning in. Please subscribe, like our show, share it with a friend who you think would benefit from it, and keep in tune because we'll be dropping more episodes soon. Thanks so much, everyone.